My first question is to make sure I'm doing everything possible to lower my W-2 taxable income. I am maxing out my 401k, maxing out my HSA, doing a backdoor Roth IRA. My employer does not allow a mega backdoor Roth. I'm aware of a 529. I don't have a 457 plan. So I just want to see if there's anything I'm missing, because even after I do all of that, I still have a very large tax burden. I mean, doing all those things only lowers my W-2 taxable income by, maybe $20,000, $30,000 or so. My wife is doing everything she can to max out her plans. But that's my question. What am I missing here? Because I'm still paying a lot in taxes.
Okay, Sam, is there anything you're missing? Well, you've got a lot of accounts there, which is good. You've clearly been reading the White Coat Investor and learned a lot from it. If you have any 1099 income, you can use an individual 401k or a solo 401k for that. If you've already maxed out your employee contribution at your main gig, then you can only put in 20% of your self-employed income into that individual 401k. You can also talk your employer into starting a defined benefit plan or cash balance plan, but you can't open one on your own if you don't have any self-employed income. And so, what do most people end up doing? They end up investing in a taxable account, which is perfectly fine. You can invest pretty tax efficiently in a taxable account. If you stick to things like a total stock market index fund, a total international stock market index fund, muni bonds, equity real estate, those sorts of things. And I'm not talking about REITs. I'm talking about equity real estate because you get depreciation deductions that you can use to offset your income. If you stick to those things, it's pretty tax efficient. You can also donate appreciated shares to charity in lieu of cash. And of course, you still get the whole deduction for what you donated, but neither you nor the charity has to pay the capital gains taxes on that. If you hold shares for at least a year, you get the long-term capital gains rates. In those sorts of investments, the dividends tend to be almost all qualified, so they are taxed at the lower qualified dividend rate. You can also tax loss harvest and deduct up to $3,000 worth of losses each year against your ordinary income. So you can invest pretty tax efficiently in a taxable account. I wouldn't necessarily feel like you're doomed if you're out of retirement accounts and you want to save more. It's not that big of a deal. I didn't have a taxable account for a long time. Now our income's gone up a lot. Thanks to all of you supporting the White Coat Investor. Thank you very much for that, by the way. But now we have a pretty sizable taxable account, and so we're having to invest it very tax efficiently, and it's really not that hard to do. It's not a Roth IRA, granted. You don't get the arbitrage you get with a 401k for sure, but it's not that bad. You shouldn't feel like you can't do it. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.